Which part of the market should you buy? After a very long bull market for European stocks, should you go for the expensive, high-growing companies, or should you look for the cheaper value option? To make the case for the latter, we're joined by Stuart Mitchell of SW Mitchell Capital, an investor with 3 decades of experience looking at the stock market. So, Stuart, I think you've got a great chart here for us, which really gets to the heart of this argument. And what it shows is sort of the valuation of the cheapest stocks relative to the valuation of the most expensive in the market.
We've got the P multiple ratio of the cheapest and most expensive. And as you can imagine, we define the cheapest on traditional valuation, on value type measures. And of course, the first thing you'll see is, you'll notice, is the plunge in 2000. Of course, that was the time when we had the dot-com boom and when the expensive got super expensive. And then, of course, we had the panic in 2008 again. And at that time, there was a move to defensive stocks, a move away from value, the cheaper. And you can see that extraordinary premium we had over there. And then it's kind of gradually, it's kind of oscillated up and down over the past few years. And then we get to this point again in 2016, where the cheapest got very cheap again relative to the expensive. And our view is we got to a really crucial, very important turning point in the overall shape and direction of the market. So at this point here, basically investors are telling you that Europe isn't going to recover, that cheap should remain very cheap, and also that the emerging world is going to continue to experience very buoyant growth. Well, we see something a little bit different on the ground. In all the work we do visiting our companies, we see gathering recovery in Europe. At the same time, we see China, which is under some pressure, and we see emerging markets not perhaps being as buoyant, not perhaps growing as vigorously as we might have expected. So our expectation, our hope is that this will reverse very sharply over the next 18 months or so as people get more and more evidence of this recovery, this gathering momentum we're seeing in Europe.
And I think you can see some of this sort of European recovery to come versus the American recovery, which has happened in this next chart.
So all we've done here is we've basically just showed you how cyclical companies on the blue line have performed in the US and how cyclical companies in the red line have performed in Europe. And it just kind of highlights that fact of, the US, where we've had some recovery, always comes earlier in the cycle, the first big area of the world to recover, how cyclicals have really performed quite well. But European cyclicals, of course, because the recoveries come a little bit later, we're an export-driven economy, and the recession was even deeper, the recoveries happened much later, and there's a very significant gap between the two.
And so what sort of stocks and sectors does that mean you should be buying on the basis of this?
So our view, what we see at the moment is a gradual recovery gathering momentum in Europe. And we think that gap should narrow. Certainly, if the history is anything to go by, we found that cyclical more value stocks and expensive stocks tend to trade roughly pari passu. So in that area, our biggest bet is in the banks, 20% of our portfolio. We tended to buy the very best quality in Intesa Sanpaolo, Lloyds, BNP, where we think are still trading far too cheap relative to their long-term prospects. We also have a collection of more cyclical defensive companies like Mediaset in Italy, Berlusconi's TV channel. We have Saint-Gobain in France, which is, of course, one of the largest building materials group, and many other positions like that.
So lots of those stocks sort of exposed to that eventual recovery for you.
Indeed, yes.
And I guess sort of, we mentioned this at the start, 3 decades of experience. Sort of looking back over that, what time are you most reminded of, sort of in your past experience, that the market seems like now?
That is a great question, and I'm kind of struggling to find a comparable time. But if you look at the performance of domestic stocks or cheap stocks versus international stocks, you'll find over the last 40-50 years they pretty much traded pari passu. And then, of course, we had China reflation and the European recession, and those two, and expensive became very expensive and cheap became very cheap. And it's really the first time I've ever seen such a divergence in my career. And my guess will be that progressively as Europe recovers and there's more disappointment from the emerging world, that those two valuation anomaly will start to narrow again.
Great. Thank you very much for joining us.
Thank you.